Welcome back to Synaptic Dividends. We break down a new dividend stock often to help you build your passive income portfolio. If that's your goal, make sure you're subscribed so you don't miss out.
Now, today we're asking, is the dividend from paint giant Sherwin-Williams a rock-solid investment, or is it kind of like watching paint dry? Well, let's look at the numbers and find out.
Okay, so first things first. The number one question for any dividend investor, and the most important one, is always about safety. Can the company actually afford the dividend it promises to pay you?
To figure that out, we look at what's called the payout ratio. It's really simple. It's just the percentage of a company's profit that gets paid out to shareholders as dividends. Think of it like your own personal budget. If you only spend a small chunk of your paycheck, you've got a huge cushion left over for emergencies, for savings, for growth. It works the exact same way for a company. For a big, stable company like this, a payout ratio hanging around 30% is pretty much the sweet spot. It's conservative, it shows incredible discipline, and it means there's tons of cash left over to reinvest in the business and handle any surprises that come along. Okay, let's dive into this. So Sherwin-Williams actually has an explicit target of paying out about 30%. And as you can see, the numbers show they absolutely nail it. Year after year, they stay right in that conservative zone. This proves the dividend isn't just safe, it's incredibly well covered. So, the dividend is safe. Check. That's great. But is it growing? Because let's be honest, a safe but stagnant dividend isn't really going to build wealth over time. We want to see some serious growth. And Sherwin-Williams delivers big time. They have raised their dividend for 46 consecutive years. That is just an incredible track record. It puts them in this really elite class of companies we call Dividend Kings. And hey, we're not talking about tiny little token increases either. Over the last decade, their dividend has grown by an average of 14% per year. That is some powerful wealth-building compounding in action right there. And what's even better? The growth isn't slowing down, it's actually accelerating. The most recent annual increase was a massive 18.2%. When you see growth speeding up like this, that's a huge sign of management's confidence in the future. All right, so we've got safety, and we've got powerful growth. But here's the ultimate stress test, right? Can this dividend survive a major economic crisis when things get really tough? And this is where the story gets really, really impressive. During the two worst economic crises of our lifetime, we're talking the 2008 financial meltdown and the 2020 global pandemic, they didn't just maintain the dividend, they gave shareholders huge raises. This proves the dividend isn't just recession-resistant, it is battle-tested and absolutely recession-proof. So what happens when we put all these pieces together? What does it all mean? Let's get to the final verdict. So with a disciplined payout ratio that ensures elite safety, a long history of powerful double-digit growth, and the fact that it's been battle-tested through the absolute worst recessions, well, the numbers are crystal clear. Sherwin-Williams' dividend is absolutely top tier. If you want to go deeper and understand the full business model behind these numbers, check out our long-form analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses. Thanks for watching.